Hello guys, in this video we try to see what are the two kinds of stocks that mostly don't follow the mood of the market. So stay tuned. Hello guys, my name is Abdelkarim. I am your teacher and coach. For this video, we try to see two kinds of stocks that don't follow the mood of the market. Now, first, we try to understand what do you mean by the mood of the market. The mood of the market is how the majority of stocks are moving. Okay? Now, how do you know this majority where they are moving? It's simple. You just see the mostly well-seen indexes, or you can see ETFs. For me, I always use ETFs because in ETFs you can buy them also. Okay? So, the most important ones that always the people see is the first one, the biggest one, is Dow Jones. You can see also S&P 500. You can see Russell 2000. You can see the stocks in Nasdaq as whole. All the stocks, how they are doing. Now, this is the mood of the market. It means they give you what the people are doing, because who moves the market? It's people. Mutual funds, manager, hedge funds, are the majority of the people. And understand, a lot of people, they don't understand this, that all the people, which is a good thing, that have a 401k and other retirement investment plans, they are contributing to the market. It means the market is always fed. It's always fed by people's money. You, for example, you have 401k, you are contributing, for example, $50 or $100 or $200 a month. This money goes to the stock market. But understand that it is not only you. There are millions of people that contribute, and mutual funds, they are buying stocks. Okay, shares from stocks in the stock market. So generally it's always going up, but sometimes we have what we call corrections. Okay, now the mood of the market is the average that you see in Dow Jones, S&P 500, Russell 2000. I always show you all these three major indexes and Nasdaq stocks index. Okay, and this is what we call the mood of the market. Now, the majority of stocks, not all of them, but the majority, are following. It means that if there is a trend, you find most of these stocks are going up into the trend. Now, few are exceptions. Some they are doing better, some they are doing worse, some they are doing the same as an index. Okay, so all this is what we call the mood of the market. But the mood of the market in general, it's the index, is the average, because they are giving the average of almost all the stocks in the index. Now, let's go now to the two kinds of stocks. First, penny stocks. Penny stocks, understand why they don't follow the stock market. Okay, some of them they follow, but most of them they don't, because they are very small companies, and the stock is very, very thin. The people, they don't trade them that much. They don't trade them that much. Okay, there are some people who are interested in penny stocks, but most of the big guys, they are not interested in these stocks because they are thin. Now, what does it mean thin? It means you find stock with $1, $2, $5, $7, or $1. They are thin. They can be moved. Since mutual funds, hedge funds, big guys, they have a lot of money. they can't go to these small stocks and buy them, because they will go from $1. In a few days, it can go to $1,000 a share if they put money into these small companies. But understand, they are not stupid to put too much money to these companies, because these companies, if they see a lot of money, they can even sell their company. Okay, if it reaches too much money. If a company is only $1 a share, it has 1 million or 5 million shares. So the company is very small, very thin. It exists, but it is so small. If the stock from $1 it goes to $10, the worth of these stocks will be too much. It's like you have $100,000 in your stock, and the next day it becomes $1 million by 10, from $1 to 10. Okay? You get 1 million, and you see the money you don't believe, so you sell. This is what happened to the penny stocks. So penny stocks, if you want to trade them, understand that they are manipulated. They don't follow the market. Most of them, okay? Not all. Most of them. And they can go high, they can go low, too much. And the percentage of their move is higher than normal. For example, check your stocks. It goes 50 cents a day. It can go $1, $2, $3 in these stocks that you own. Okay? And the percentage is, for example, 50%, not 50%, 0.5%, 1%, 2% daily, up or down. This is how they move. But a penny stock can move, for example, in normal, it can move like 10% a day, up or down. So 10% is too much, because the stock itself is light. It can be manipulated as much as they can. So these kind of stocks, they don't follow the market. It means if the market is down, maybe these stocks are going up. So don't worry a lot about the mood of the market. Okay? Now let's go to the second kind of stocks, are IPOs. IPOs have what we call a momentum. They go up and they go down, not because of the market, but because of the momentum and the people that are watching this IPO. Okay? So there is a lot of volatility in these stocks, and most of these stocks, they don't follow. For example, most of the IPOs, they go down. Even the market, the general market is going up, but these stocks are going down, going down, going down. There are just few or some stocks that do well in a year, especially when they begin. Now, the reason for that is that analysts, if they say bad about these IPOs, people, they will be hesitating to buy. Okay? But if these stocks are going up from the beginning, from the first week, the first month, or 2 months or 3, and they are beginning to go up, there is a probability that these stocks will do excellent. No matter how the market is, they will do excellent. Except when they become big and very known, and the people, they know them, so they become part of the mood of the market because they are known and they always talk about them. So traders, they come and they treat them as a normal stock, as the mood of the stock, mood of the market. Okay? So try to pay attention to these 3 kinds of stocks that I spoke about. The first category is the majority of stocks that follow the market, which is the mood of the market. You see, for example, you go, for example, Dow Jones. Okay? If it is a good day, you find most of the stocks in Dow Jones are going up. So you say, why? Why all these stocks are going up? Yes, because they follow the same index. You find only 1 or 2 or 3 that don't follow the Dow Jones, for example. Okay? Then the second category are penny stocks. As I told you, they are very thin, very small companies. They are very volatile. Some they manipulate these stocks. Some they do a lot of fraud, a lot of manipulation, a lot of scams in these stocks. So be careful of that. And the third one are IPOs. IPOs are, because of the momentum, they can go up so high, they can go down so high without looking at the mood of the market. It means they don't follow the mood of the market. For example, Friday the market is down, you find these stocks are going up. So there is no relation. Okay? So thank you very much, guys, and see you next video.